Ever since November 9th, I have received 18 separate requests on email for an interview with Dr. James Mworia of Centum Investments. And I must apologize to all our viewers. I said that they were in their closed period. The half-year earnings were coming up. That was the best time to have a conversation. And we are privileged to have Dr. James on set. Welcome.
Thank you, Julian. It's always a pleasure.
Asante sana, tunashukuru. Let's dig into the half-year numbers you've just released. Your loss after tax trimmed quite significantly. When I look at the numbers, the portfolio companies especially, I struggle with the efficiency question in the business. Let me just walk you through this. Trading business operating costs are up 116%. Financial services costs are up 29%. Real estate up 45%. Two Rivers Development down 17%, quite impressive. Investment operations and admin costs are up 13%. Finance costs are down 28%. From an efficiency standpoint, how would you assess the business?
Julian, that's a good question. What about the profitability? If you looked at the profitability growth of the companies, you know, the focus of any business is to make a profit, not to cut costs. You know, costs are enablers of a business, and all these businesses, if you look at them, the reason, to your point, to why the performance has improved is because the operating profitability of the companies has significantly improved. And the key thing is that revenue has grown much faster than costs. And these businesses in COVID, they had a significant retrenchment of costs. So we moved very quickly to cut costs, to bring them in line with the revenue, but still revenues came down so significantly that we ended up with losses, so that revenues were below fixed costs. There's only so much we could cut. But once business starts coming back, our foot as a portfolio manager for a lot of these businesses, we want revenue, we want bottom line back, because the driver of value in all these businesses is a profit after tax. So the way we do our evaluations, the major driver is on profitability basis. So the critical thing is how quickly can you optimize your profitability back to where you ought to be and make up for lost ground while remaining efficient. So for me and for the entire team, you know, we are happy that, you know, we are encouraged with the progress. We are encouraged with the progress around profitability for each of the companies, and actually all the companies had improved profitability. I think the second thing is that for business like Centum Re, the issue they have with their cost structure is that the majority of their profitability is deferred, in the sense that you're incurring costs today for projects which you've substantially sold, but where you'll recognize profit in the future. So when you're looking at their P&L, there's a mismatch between revenue recognition and expense recognition. The expense recognition is coming upfront. And as they have ramped up activity, you have increased costs. And all those costs go through their P&L in the period that they are incurred, even though then revenue is recognized at the point when that particular unit is sold, completed, handed over. That's the other issue. The second issue in that business is that the bulk of the profitability on the sale of development rights has been booked in the previous periods through revaluation gains. So when you then sell, you are then the cost basis is not the original cost. The cost basis is the most recent revaluation. Now, because you've done a very recent revaluation, it's very difficult to sell at a value significantly higher than that revaluation. So although you have a huge cash profit, that cash profit is not cycling through your P&L. So Centum Re sort of gives you a distorted efficiency metric. I think moving on to Centum as an investment company, which is important, and I think in our last discussion we had a conversation around this, our cost to income ratio was 44%. So we have investment income coming into Centum, and then for every 100 shillings that was coming in, we're spending 44 shillings last time when we met. We are now down to 30 shillings. We've done further reorganization of our business. My own target is to bring this to like 20 shillings of the investment income that comes in, so that then the 80 is available either for investment or paying our shareholders dividend.
James, I think one of the bright spots I saw in these numbers released this morning is on the marketable securities. And my question to you is, the last conversation we had, the target for marketable securities is about 20%, and you're already at 9%. 19%, sorry. Is the 20% a moving target, especially because when you look at the environment outside, fixed income is giving increasingly attractive yields from the government side, and we're seeing a lot of investment-grade corporate paper now coming in.
Julian's, look, I say investment is like dancing, you know. You have to dance to the tune of the music being played. And the tune, in this case, is the outlook on the economic environment. So if I look back to 2009, the outlook was such that we felt that there were going to be more growth opportunities investing in businesses for capital growth than investing in fixed income for a fixed rate of return. In fact, in that environment, we were an issuer of government securities as an investment company. We issued a bond in 2012, we issued another bond in 2015. Why? Because we believed that there was more value to be created by borrowing at 13% and redeploying it for capital growth. I think coming into 2018, 2017, our view was that the way the economy was behaving and the signals we were seeing was that was not necessarily going to be the case going forward, and that we needed to dial down on risk and take our winnings where we had winnings, reduce, so shift from being an issuer of debt to a provider of debt, and then shift the P&L structure. Because if then you believe there are not going to be room for huge capital gains, then our P&L up until then had a significant line income on gains on disposal. Because as you create the value, you then realize it through the exits. If you believe that going forward that is going to be a muted line, then our view was then to shift the allocation towards investments that would generate a cash yield to replace the gains on disposal that we thought were not going to happen as had happened in the past. And so we made a decision to move our fixed income. At that time, our marketable securities portfolio was only 3% of total assets, and even that marketable securities was largely in quoted equities. So we have gone all the way to 20%. Now, this half year alone, we further increased. So we continue to see opportunities in that segment of the market. Our average cash yield is now 15% on cash only, which is even higher than our borrowing cost, because our effective borrowing cost is 12%. So as we continue to see opportunities in that space, we'll continue to deploy capital there. And given the work that has been done around reduction of interest expenses, of operating costs, dividend is at 30%, we expect to have surplus cash. And that surplus cash can then either be redeployed into MSP or into PE when you get the right opportunity.
On the call, you spoke about seeing monetizing events for mature assets. And my question to you is, we've had a conversation about Centum HY before. Beyond Centum HY, are you seeing any such opportunities in the medium term at least?
In the investment world, and maybe we'll come to that question later, in my world, I've been CEO of this business since December 2008. The way we've grown the business is by investing, growing value, exiting, and redeploying the capital. That's how we've moved assets from slightly less than 6 billion to where they are today. So you always have to have your mind, if you're the CEO of this business, about value creation and exit. For all your assets, you always have to think about the exit, because the assets you have are your working capital. So if you don't have an exit, it means your capital is then stuck. And so we're always having, at any given time, an exit conversation, potential exit conversation taking place. And what we've done for all our assets is that we have mapped what is our break-even exit value based on the value creation plan. If today you gave an offer for any asset, we have an exit value that has been approved by the FIC for all our assets. 2021, 2022, 2023, 2024, we have a break-even value. And we are a seller at any value above that, because holding it above that means that we are then earning a return lower than the cost of capital. So that's sort of how we're doing at it. So for Centum HY, we did communicate to the market that we wanted to bring in a minority equity investor into the business. our investment thesis has always been around creating investment grade assets. And because we were very constrained for capital at the beginning, we then had to actually originate these assets from scratch and build them all the way to be corporate enterprises and then bring in investors at a value uplift. And we are having very interesting conversations with a number of investors who like that particular asset. It is moved from being bare land to an asset with financial assets, financial receivables, whether it's in the form of profitability on deferred profitability on infill developments or receivables on sale of development rights. So it's an entity that is playing a significant role in development of affordable and medium income housing across the region. And there's a lot of interest in that particular space, and maybe in the short run, we may be able to make an announcement around what has happened around that asset in terms of getting a minority investor. We intend to continue to hold it because it has been one of our more successful investments, and we still see a lot of potential in that business going forward.
I know you're really constrained by NDAs, but maybe just tell us, how many are you looking at in terms of the number, potential investors?
I think you're sort of mostly now in exclusivity, so you're probably having a discussion with one or two serious investors.
I see.
Yeah.
Great. James, ever since November 9th, the Centum share price has tanked by about 12%. Yeah. That's about 1.2 billion of market valuation just wiped off. And I don't think I know of any other executive in this market as concerned about the share price as James Mworia. One, does that bother you? And in the past, you did mention that the company is actively engaging in initiatives to rescue the share price. Could you give us more detail?
Way back in 2009, we were largely invested in marketable securities. So the structure of the portfolio was 70% marketable securities, largely listed equities and fixed income, and unlisted securities were 30%. And the issue then, we were still trading at a discount. And the feedback investors gave us then was that, why should I buy Centum for it to then invest in securities I can invest in directly? So we did not have an issue of price discovery, because the issue you have with unlisted securities, the concern investors have is an issue of, are you valuing the underlying assets fairly? And we have sufficient visibility of the performance of the underlying assets to validate the valuation. So we didn't have that problem. But the problem we had was that, what was the rationale for existence for Centum? And we agreed with those critics, because we said it doesn't make sense for Centum to be a mutual fund. It's then a very expensive mutual fund. And therefore, we then started changing and changed and said, look, let's give investors access to otherwise inaccessible investment opportunities. And then had a shift now from these marketable securities to inaccessible investment opportunities, which meant that they were not available in public markets. Then we started now having another conversation. How are you fair valuing the assets? And we started having this price to NAV gap. And now the solution then was to say, let's validate the valuations through exits. And we've had many exits that have been at a premium to carrying value. But we seem not to have never really answered that debate, regardless of the exits that we've continued to do. Then, of course, we've had a successful run with Centum Re. Again, investors ask the question, how are you valuing the underlying assets? So the solution is then, let's sell the development rights and demonstrate and actually see whether we're able to realize the carrying values, which is now what we've done. Not just sold them, but this September we said, let us actually disclose what the selling values are relative to the carrying values. We've not made those disclosures before. And as I was explaining today, based on what we've completed and what is in progress, the selling values are 10% above carrying value. So what we are hoping to do is, through these additional disclosures, to make these points clearer. The other criticism we faced is your cost structure is such that I need to take the present value of your cost and reduce from NAV. So then the point was, let's cover costs within the recurrent income. And that we've addressed. The third issue was, your finance costs are such that they are so high that they present financial risk. Then you said, okay, then let's repay the debt. So it's been like an expectation treadmill, where you keep on addressing one issue after another. I think for me, although we are concerned about the share price, deeply concerned about the share price, we've done a lot of work analyzing also the volumes of shares that have driven the share price over the last 4 years. And we have 660 million issued shares. The average volume of traded shares is about 30 million, so it's about 5% per annum. Yeah. So these have largely been driven by small retail investors who are selling, not the large investors. So the good thing is that our large investors have remained largely stable. They see the long-term value in the entity. But at the moment, I would say we are having a significant pricing up. And that's one of the issues the board has asked the Finance and Investment Committee to now look at critically, is now the share buyback as an investment. Because we can buy those shares back as one of the investments of Centum, and when the price recovers, maybe resell them in the market. So there's an ongoing, so the FIC was actually tasked at yesterday's board meeting to look at this and give a specific recommendation to the board. Hopefully it will help. Hopefully it will give an exit for the minority investors who wish to leave, and allow those who are staying for the longer term then to sort of ride it up, and maybe we may sell those shares or use them as treasury stock in the future.
Fantastic. You've spoken about the finance costs, and something of deep interest to me, James. I've been combing through the Centum evolution of the strategy, 1.0, 2.0, 3.0. And I have a question for you, James. My own assessment is that Centum should have gone for an equity raise. And why that would be ideal in my view, it would enable you to cushion some of these heavy finance costs. If I walked you through the finance costs, they're crazy. James.
Yeah, what we've spent in the last...
Exactly.
Yeah.
So why wasn't that an option on the table? And more importantly, was there fear of dilution by strategic investors, key investors if I could call them? Because that for me would have been a very optimal capital structure.
That's true, Julians. Every CEO, ask any CEO, they would love to have more equity in their business. Yeah, you see, as a CEO, I am hired by my principal to deliver their mandate within the constraints that you have. So when I was recruited in December 2008, the mandate I got, we want you to grow the business. And I asked the question when we had our strategic retreat in January of 2009, are the shareholders going to put in more capital? And they said, no, James, we have no more capital to put into this business, okay? Can I go out and raise more equity capital? He says, no, we don't wish to be diluted. So what can I do? You can borrow, and you can retain the dividend for the first 5 years. So you work within, you dance within the tune that you've been given, and you perform within those constraints. So when I took over this business as CEO, there was exactly 10 million shillings of cash in the balance sheet. If you had gone back to 2009, there was 10 million shillings of cash in the balance sheet. There was an overdraft of 180 million shillings. And there was 5 billion of assets, largely made up of illiquid minority stakes in a range of companies. And the vision was, we want you to move this balance sheet to 30 billion. And you cannot raise equity. We are not going to put in equity. You can borrow. And that's what I signed up to do. And that's what I've been doing. That was my brief, yes, is to then work within those constraints, go to the market, borrow, invest, grow the value, exit, pay the debt, and leave a residual equity, create value for us. And I delivered with my management team to the best of my ability. We moved book value of shareholder funds from less than 5 billion to what it is today, close to 40 billion shillings. We've not raised a shilling of equity capital. We've distributed 4.1 billion shillings in dividend. Yes, we incurred very heavy finance costs, but that was a price the shareholders were prepared to pay for growth, because they were not putting in any money of their own. They were riding that particular wave. And at the end of 2019, the mandate then was, you've done your job well, now we want you to pay down this debt that you've taken over the period. We did that within 2 years. 2019, 2020, it's negative. Today, our marketable securities, net the debt, is a positive 3.5 billion shillings. So I wish I had more equity. It would have been a more comfortable job for me. I wish I was investing in private equity. Plus, remember, then you're taking additional risk of now having debt invested in an illiquid asset class, where Africa PE industry, most investors will tell you the biggest challenge they have is exits. Now, when you've issued a bond and the redemption of the bond is dependent upon you creating value in a company and exiting, and you have a hard redemption, you can imagine the stress you face. Plus, you then have quarterly interest payments. So that has been the performance of the business within those constraints. And for me, I'm glad by and large we delivered on that mandate. We've delivered on that mandate. The new mandate is now grow using your internal funds. We are still not out there raising equity capital. There's no intention to raise equity capital. Grow using internal funds. And in 2014, to your point, rather than raise equity, which I agree with you, we ought to have done, we actually reinstated the dividend policy. So we still had a huge growth ambition with dividend, with debt service, and we've delivered what we've delivered. So I'm glad you've gone back to look at the financials, how the business has been funded. And you see, I tell a lot of investors who ask me, I say, none of you has put in any money. I've not taken anybody's money. I took the 10 million shillings, the 180 million shillings. Everyone we've borrowed, we've paid back. And we are where we are. We've created value. Yes, we have a price to NAV gap mismatch, but I'm glad it's not the other way around. I'm glad we don't have a lower NAV and a higher price, because that then is not grounded on fundamentals. I think this might be an easier problem to fix than if it was a converse.
So James, let me walk you back to your younger self back in 2009, the retreat. If you're given a chance to go back, would you have done things differently? Would you have told them, guys, this is what makes sense, keep your job?
No, I would not have done anything differently. You see, I believe you're never in a perfect world. You know, you work within the constraints that you have. It's very important to understand the constraints of your stakeholders. And I had a fantastic working relationship with my key shareholders for that reason. Is that once you understand your mandate, you deliver to the mandate. So the role of any investment manager, you deliver to the mandate of the client. I have a client here, they have a mandate. My responsibility is, I believed I could deliver to the mandate, and my responsibility was to build a management team that delivered on that mandate, and I'm proud that with what we've delivered. Of course, it would have been more comfortable if we had equity capital. Then the timing of our exits would not be under as much pressure. But that was not the mandate I had. So no, I would not have done anything differently, because this is the opportunity I had, and that's the opportunity I grasped within the mandate that was presented to me.
The June 2020 retirement of debt, was it the best solution? Because you have made exits, you have this cash, you're getting into what I think is a very capital intensive phase. You've got 2 rivers, etc. Could you have stepped back on the retirement of the debt?
See, the issue of debt is that you're accruing. The challenge with private equity or equity investments is that you have a yield that is significantly lower than the interest yield on the debt. So the average cash yield on our portfolio, the assets we've exited, is not more than 3%. But you're accruing interest at 13%. Some of the debt is also foreign denominated. So it might be 7%, but if you add the currency risk, it might be going to like 10, it might be going to 17%. So for me, the risk I was looking at is we had worked for 10 years. I don't want the capital we've built over 10 years to be eroded by underperformance in the next 2, where this debt now grows faster than the asset, and you end up wiping the equity. So you get to a point where you're now on capital preservation mode. Largely because then you look at the economic conditions. Are economic conditions supportive of an aggressive strategy? At that time, we did not even know there was going to be COVID. So this was pre-COVID. So if you take into account then COVID happened, I'm glad we did not take that 19 billion and redeploy it to another asset. Because maybe now that 19 would be 5. And then you still have the debt now that has moved from 19 to say 24. Plus you have debt service. So I think there's a time to be aggressive. There's a time to be cautious. And you need to read the environment you're going into carefully. So in my view, even with the benefit of hindsight, I think it was the best decision. I'm glad we did not redeploy that capital to more risky ventures, because even the shareholders who are left in the business we exited, they're still trying to exit today at a lower value than what we exited at 2-3 years ago. In the interim, we've saved significant amounts in finance costs. So the strategy come 2017 was, you've created value. Now preserve that value. That was a game plan. And then now reward your shareholders sustainably using your recurrent income. So whether you have an exit or no exit, you can afford to pay a dividend. That's why the dividend is at 30% of investment income. So grow that recurrent investment income. The assets you have, try and increase value. And if you can, work on a monetization event so that then you can recycle that capital back into new opportunities.
Okay. Looking at the business now from a debt service coverage ratio standpoint, how comfortable would you say you are today?
No, you just need to look at our half-year performance. Our interest expense is 200 million, investment income is $1 billion, so it's 20%. If you look at marketable securities, only 7.8 billion, debt is 4 billion, net is 3.8 billion. Go back 2017, debt was 19 billion, marketable securities 3 billion. We had a mismatch, we had a liquidity mismatch of 16 billion. The income, the larger income that we were working on was gains on disposal. But that is because the environment allowed for you to operate that way. Today, the environment does not allow you to have those kind of gains because multiples have also come down. So 5 years ago, in 2018, we could sell an asset for 10.5 times EBITDA. Today, PE's price to earnings ratio is at 5 times, let alone EV, enterprise value, EBITDA multiples. So I think, look, this business is difficult because you also have to read the environment. And you're in an environment where there's so many variables all happening at the same time. So I think we made the right decision. You see, look, as I told you when we met 6 months ago, my objective with the chairman of the FIC, the late Chris Kirubi, coming into 4.0 was, let's dial down risk in this business. We've had a good run. We've created value. Let us secure that value. So whoever comes and runs this business finds a steady business. And that's what we're working into, because we looked at the environment and say, look, the environment may not be as benign as it has been in the past. And the past allowed us opportunities to create considerable value, but also to take bets that may not necessarily have worked. You had that comfort that the upside on what worked would offset what did not work. Maybe the environment you're going into may not be as benign, and that's what we've seen since 2019 with COVID, the economic challenges we've had, the reduction in market multiples, the reduction. So there's been a whole host of challenges.
Still going back to the Centum strategy, one of the investments which I have struggled with in my reviews is the Akira investment. Yeah. And the reason is you are going into an extremely capital-intensive area, which is not Centum's core business, if I could put it. And also the fact that if you look at other players, the main players in that space, they benefit from a lot of concessional financing. So they can take on that risk. How is it doing? And when you look back, are you happy with it?
You know, Julians, these are decisions, these are things you can look at with the benefit of hindsight. You have to play back when that decision was made. That decision was made in 2013. In 2013, I still remember that when we presented this opportunity to the Finance and Investment Committee meeting, there was huge demand for power. Kenya had this idea around 5,000 megawatts. Akira had been at it for a while. They obviously had a PPA. They have a concession area which is just next to Alkaria. All the studies showed, look, the significant geothermal resources here. We had investors who are just prepared to come in after we got to 25 megawatts. So we're going to sell our stake. So our 2 billion investment, we had a pre-exit of 3x. And we had a very experienced driller. We also took insurance against the drilling risk. So in business you mitigate your risks, but the reason you make 3x is because there's also risk. You don't have a 3x investment for no risk. If we had come later, whoever was coming later, they were coming in at an IRR of 12%. That is not an exciting IRR. For us, it was an early stage investment, which was the kind of deals we liked to do. So we tried to mitigate our investment to the greatest extent possible. So with the information we had then, I think it was the right decision. How is it doing now? I still think that my view is that for Kenya as a country to reduce its cost of power, the only solution is to develop the naturally occurring power sources within your own country. People talk about Egypt's lower power advantage, but that is because it's largely hydro, which they have in large quantities. Some of it is LNG, which again they have in large quantities, or South Africa, it is coal. What here we have in large quantities is geothermal. So if we develop our geothermal, then you can replace expensive HFO and other sources of power, because you don't need to import the fuel cost element. The fuel cost element is the most important element. So my view is that geothermal has a very critical space in the development of power for this country into the future. We have a good field. We only ran into challenges around the original process of drilling. So it was more of a drilling process challenge rather than a lack of a reserve issue. And we are now in advanced discussion with a partner to work with to do a joint development of the field. And this is a partner who has a competitive advantage on the geothermal development process. So just taken a bit longer, but I think that is the nature of geothermal, is that sometimes it may not happen as fast as you expect, but the field we have is fantastic. It is part of the Olkaria field. I think there's demand because you are displacing more expensive power. It is green energy, and I think government ought to, because if you look at an organization like GDC, which has been funded at taxpayers' cost, and they have amazing equipment, there's no reason why we should be spending a lot of money as private developers to develop geothermal field, which will then save the country foreign exchange of importing HFO. I think there's need for government to come and support developers in the development phase of geothermal, because you're developing a country's natural resource, and you can even offset that from the tariff. So at the end, the tariff, what you're left with is the cost of the plant itself, rather than the cost of the drilling. So it's what Chris used to say. You're in such a place, to go back you can't, to go forward you must. So that's where we are with some of these opportunities. Yeah.
So James, you and I know that as we speak, there's a lot of flux in the operating environment of the energy space. And one key factor is the negotiation between IPPs and the sole off-taker, Kenya Power, regarding issues of tariffs. So how are you baking this into your consideration when you think about Akira?
I think there's a conversation happening. But in my view, I think, as I said, I think the real solution, because what is the intention? The intention is to reduce the cost of power. That's the intention. Why is the cost of power high? It's because for a period of time, the new power that came onto the grid was expensive power. It was HFO power. And what is even higher is not so much the capacity charge, it's the fuel charges, because you're importing the fuel. It is even made higher now by the foreign currency impact. Now, even if you negotiate with these people, you cannot really reduce the fuel cost element, which is a larger element, because it's a pass-through. So those renegotiations, in my mind, you'll be burying your head in the sand. If you don't address the core issue, it's a mix, the generation mix. And the only solution now is to go to what you have a comparative advantage in, which is geothermal, and fast track whatever development is in the pipeline to enable you replace and stop dispatching expensive power. Because if you only left, if KPLC is only left with the capacity charges of the HFO IPPs, then you'll bring the cost of power significantly. So with everything, you see, eventually the fundamentals will come to bear. So for me, I actually think it's an advantage, because then suddenly people realize, look, the Akira HFO geothermal is 8 US cents. So if you look at it even on the matrix that was put out, it's one of the lowest power producers. So I hope a policymaker looks at it and says we should support Akira to come on stream even faster. It's part of our solution.
You've reminded me, when I was assessing the evolution from Centum 2.0 to 3.0 and speaking about the capital constraints, one of the challenges that I had was reconciling the 2.0 agenda of, in the real estate space, identifying undervalued assets, getting in, and then now you come in with the Two Rivers and very heavy infra.
Yeah.
Why that?
No, you see, when we started 2.0, that was the idea. You have a hypothesis, yeah? But then you go to the ground. The ground is different. So when you went to the ground, there was no, what we realized, there was going to be no competitive advantage for us to go and buy an acre in Kilimani and develop it. We're not going to be competitive. Our procurement processes, our structure meant that we could not compete with Julian's as an individual. We then said, look, we need to do real estate development at scale, because then there we have less competition. So when you came to Two Rivers, the idea was develop the concept and bring other investors in. So if you look at Two Rivers, Centum is one that has invested the least, but we brought in investors at a value uplift. So the capital that is at risk is the one that you brought in to do the investment, yeah? But then also there were lessons learned. By the time we went to Vipingo, which is even much larger than Two Rivers, the idea had changed, because you learn. We said, let's not front load infrastructure. Let us front load what is bringing money, which is the infill development. And even that infill will now not build before we pre-sell. Let us pre-sell and then build, and then let the infrastructure be the last thing you bring in. That's why that particular investment has been a lot more successful than this investment. So there's also been a learning curve in what we have done. Now, that is the plight of entrepreneurs, because you are charting a new path. No one had done what we were doing before, but we thought there was a need for you to have spaces like this, where there is high quality infrastructure, where there are services. We also knew we did not have the capital, so we had to go and raise the capital up front, equity capital. Unfortunately, what happened, even with Two Rivers, the intention was to have all the infrastructure equity funded. But as is the nature of this thing, you end up with cost overrun, so you end up with debt, and that's the debt we are now trying to refinance with equity. It still works, it's still a huge equity value within the company. But that's the nature of entrepreneurship. Yeah, if we were following today like a follower, we would have done it differently, because we would have had another entity that has done it before us that we could study. But we all appreciated, look, this is what we're going to do. And to your point, we've always done things that are not in our circle of competence. Centum is a confident entity. It's an entity that believes they can succeed in different areas. We have never done anything in real estate before. And now we are one of the largest players in that field. And we are also very nimble. Maybe in 2 years' time we'll have exited completely, and we'll be in something totally different. So that is the nature of what this organization was all, has been all about. And that's why for me, it has been extremely enjoyable to be part of this journey.
But James, speaking about venturing into spaces which are not in your circle of competence, when you look at the residential side of real estate, for instance, they've got multiple players who have the benefit of being able to play around with their costs in a very nimble way, if I could say. When you look at that vis-a-vis Centum's position, don't you think then it's a very tricky?
I think we've tried our best. You know, if you look at where we are with our model, we are probably right now developing about 2,000 units. 75% of them are sold. Of that 75%, you've collected about 40%. We've tried to, we're doing a scale game. It doesn't make sense for us to do development of 50 units, 40 units. It will move the needle. And we've done that within a short period of time. We started that in 2017, 2018. And we have now an embedded profitability of about 4 billion shillings. So you're scaling up. So it's about not just not within a circle of competence, but it's about building the competencies quite quickly and then scaling it up. And I think that's the advantage of that hunger comes. Look, to your original question, if probably we had raised 2, 3, 4 billion shillings in 2009, maybe we would not have had that hunger. We would have been comfortable. But now you're very uncomfortable. So you have no choice but to learn and scale up quickly because you need to get the capital out of that business to return to the providers of capital. So I'm proud with what the Centum HY team has achieved within a very short period of time in terms of building up a business of scale, not just in Kenya, but in Uganda. And that is actually what has catalyzed the sale of development rights. Had we not done it, the sale of development rights you're seeing now would not have happened because our original strategy was to sell development rights to developers. And then developers came and said, look, we don't think it's going to be profitable to develop here. So he said, okay, let's do it ourselves and see if it's true. It's not profitable or there's not going to be enough demand. And we did it and I think we have sort of validated the question. We've answered, the question has answered itself here.
What's the future of the PE business? Why I'm asking this is because we know Centum has a very aggressive approach in unwinding its debt and therefore capital constraints. Is Centum looking to put up a fund of sorts to be able to take on more risk? In the event, I know you've mentioned that Centum 4.0 is about dialing down on the risk, but private equity remains a core part of your business.
Remember, growth equity, even Centum HY and TRDL are part of the portfolio. Yeah. It's just that they're in real estate sector. You have other assets in financial services, you have assets in power, you have assets. So those are all assets of within the growth equity, about 40 billion shillings worth of assets. The only difference between Centum and a lot of PE funds that we are not in the market raising capital all the time. Yeah. And that's because of the constraints we have at the shareholding level, where the shareholders are not keen on being diluted. But now you also have an additional constraint of where the share price is. Actually, you're doing the opposite. Instead of raising equity capital, you're actually buying back. Capital. So the solution there is, that's where the exits are critical because you can only make reinvestments out of exits. Part of the problem we've solved is that before we were distributing dividends out of exits. Now we are distributing dividends out of investment income. What that means is that the exit, whatever you make from exits, is entirely available for reinvestment. Now, the criteria we have for new investments is that the investment should be able to give a net present value of at least 1 billion shillings. Yeah. So, that has eliminated a lot of opportunities. Because, what we've learned is that, PE investing is a long game. So it had better be worth it. And you're going to have a lot of difficulties. And it's illiquid. So for you to go and invest to make an NPV of 200, 300 million, 400 million, you can have 10 deals and you're very busy, but you will not move the needle. So if you look at the challenges, say, we've had in Centum HY, it has contributed to some of my hair disappearing. But look at the NPV. It's worth it. Yeah, we're about to get all our money back. So what is likely to be left there in another 1 year or 2 is just a profit. Yeah. So the challenge has been that right now, has been finding deals that meet the NPV criteria. You have an IRR criteria of 25%. Many of them pass that IRR. The challenge is the upside, yeah. The scalability remains low. but you don't want to do a deal for the sake of doing a deal, because it's like a marriage. You get in, you're stuck with it for another decade. So yeah, I know people are anxious. When are you doing a deal? When are you doing a deal? But that's those who've done deals, what it means to do a deal, create value, and ultimately get out of it. So I think when they find something, they're looking at a couple of them. And when something works for us and that we can really put in effort to scale up, then we'll go for it.
My very final question, I won't ask another one after this. In our last interview, I asked you about concerns regarding key man risk and the late Dr. Chris. In a question to that interview, someone asked me, why didn't you ask him about James Mworia as a key man risk factor in Centum?
I think what we've been doing, if you look at 4.0, actually we're managing that issue of key man risk. The business was in a very entrepreneurial phase. Even the underlying portfolio companies were highly reliant on James Mworia being involved in the management. I was effectively the CEO of Centum and a whole host of portfolio companies. What we've been doing is, deliberately doing, is dialing down that risk by devolving management to portfolio businesses, having governance structures at that level, and reducing the role of Centum in the management of our portfolio businesses. So my role now is largely capital allocation, participating in the value creation processes of the various businesses. So it has significantly reduced from when I was actually actively an MD of all these businesses that we've developed. So yes, this key man risk, which is inherent in an entrepreneurial business like the one we're in. So that's an inherent risk, but it's a risk we've been dialing down. And I think looking at where we are now, where even the cash flows are not so much reliant on exits, and you have businesses that have standalone CEOs, boards, I think we are there. James Mworia can be hit by the proverbial bus, or might go on a rocket to the moon, and the Centum should continue to run.